You're listening to Seattle Real Estate Podcast.
Welcome to the Seattle Real Estate Podcast, formerly known as Only in Seattle. We're changing up our branding, and so from here on forth, we're going to go with the Seattle Real Estate Podcast. And I am Sean Reynolds. I'm your host. I am the owner of Summit Properties Northwest and Reynolds Kline Appraisal. And the title of this podcast is Why the Seattle Market Won't Crash in 2020. It's the beginning of February, and there are still a lot of predictions being made as to what the real estate market will do in 2020. And I've seen a ton of misleading headlines and misleading stories in the media, and I want to go through some of that. And then I also want to share some of my own experiences with what's going on in the market with Summit Properties Northwest and on the appraisal side, on Reynolds Kline side. So let's jump on in. And I appreciate the listeners and the viewers on YouTube tuning in to this episode of the Seattle Real Estate Podcast. So the first thing I wanted to talk about was we all keep hearing, and this is on a national basis, that there is no inventory of housing. And I know we keep harping on that, and people who don't care about real estate. Real estate's a kind of thing that when you need the information because you're going to buy or sell, you're going to jump into it like right now. Otherwise, you don't really care about it unless you're an investor or you make your living this way as maybe a real estate broker, or you're entitled escrow, you're an appraiser, something like that. But for those of us who make our living in real estate, we've been hearing now for years, literally like the last 5 years, that we have a limited amount of inventory. And I wanted to share a couple of quick stories that really exemplify where I think we're at with the marketplace. The first one I have is a listing that came on last week. This is Summit Properties Northwest listing, and it's a property up in Lake Stevens. Lake Stevens is probably, it's about a 30 or 40 minute drive from downtown Seattle or downtown Bellevue. It's a little bit outside of the metropolitan area. It's a commuter neighborhood. You would commute in from Lake Stevens to either Everett, which is a big city up north, or into Bellevue, Redmond, or Seattle. But not a lot of employment up in Lake Stevens. So it has some more affordable housing. The property that we brought on the market last week came on at $459,995, so about $460,000. That might sound like a lot for a lot of neighborhoods or a lot of markets, a lot of cities, but this is about as cheap as you're going to get in our marketplace, in the Seattle marketplace, for a home built in 1990. And this property was purchased in July of 2018 for $430,000. $440,000. So putting it on the market at $460,000, we've got about a $20,000 increase. Now that doesn't sound like a lot, and especially in like Seattle proper, that would be a very minimal increase over a year and a half. But this is further out, and so when I looked at it, I thought, wow, that's aggressive pricing, but let's just see how it goes. So on the first day that it was placed on the market, my broker, Tom Bosserman, had multiple phone calls. And he ended up getting it sold in a couple of days, and he had so much activity on this property that he probably could have bid it way up, but he basically just wanted to get a sale and get something moving towards escrow and get it done. And that is one thing that I'm recommending right now is take your time. If you're putting a property on the market, if you're a seller or if you are a real estate broker, take your time, because there are way more buyers than there are properties right now. And if you've brought a property to market, you don't need to sell it in a day. I was just reading a post where bragging about selling something in one day is not really something to brag about. You need to expose the property for a longer period of time on the market. People want what they can't have. It's kind of like in The Wolf of Wall Street, where Leonardo DiCaprio was making the point of, how do you sell a pen? You take it away from somebody as an option. They can no longer buy the pen. Now they really want the pen. So if you've got a property and there are already 4 or 5 offers on it, that is something somebody can't have. They can't have that home. Now they want it even more. So that's the position you want to put yourself in, as either the seller or their broker. Not necessarily, sold it first day in the market. But whatever, everybody's different. That's just my opinion. So this property went on the market. We had a ton of activity, and that to me told me, all right, It's not just the closer end markets, it's everywhere that we're going to be off to the races in 2020. There's just not enough market inventory to go around. The second story that I have that I think exemplifies this even further is a property in Seattle. It's on Alki Point, and that's the north end of West Seattle. It's got it's basically on Puget Sound, and it has some great kind of views back to the northeast of downtown Seattle. It's the bay that when you take a ferry out of downtown Seattle and you're headed west, you look off to your left, and yep, there's West Seattle, there's Alki Point. It's just kind of an epic scene. It's got some really super pretty views of Puget Sound, and then off to the west, you've got the Olympic Mountains. So this home that I'm talking about is on Alki Avenue Southwest. It's a main drag, unobstructed views across the street, which is Alki. Summit Properties Northwest had this property on the market at $1.25 million last year, and it's a decent house, but it's nothing great. It'll probably be torn down for development somewhere down the road in the near future. That's kind of what's happening in that neighborhood. But this property we had on the market last year, 2019, kind of at the end of summer for 1.25. We had it on the market for about 60 days, not much activity, not much interest at all. And we dropped it down from 125 down to 1195, and then ended up taking it off the market in November. Just lack of activity. Did want to have it hang on in the market over the holidays where you just don't have much activity. So in this last couple of days, we had an unsolicited offer, full price, for what we were asking the second time around. And that to me is always an indicator that even though this property is expired, it is not actively marketed. There is no inventory for people to look at, so real estate brokers and their buyers are going through expired listings. And so what that means is that they are looking at something that is technically not on the market, and they are making offers because there's nothing else out there to buy or to look at. So people are getting creative, and the last time we saw this was 2017. That's when the market was at its absolute peak in recent years. And I think that is where we are headed with 2020, not because of that's where we are in the marketplace, but because that is what's happening with our dynamics, our lack of supply and our big demand. So those are two kind of instances where I think locally that shows where we're at. And I've been making this prediction that 2020, you're going to see some pretty good sized price increases, just because when something does come on the market, there's going to be multiple offers, and you're going to have some escalation clauses in there, which means somebody offers $1,000, $5,000 more than the highest price up to XYZ price. And you're going to see a lot of that because there's just so few properties to make an offer on. That's what it's going to take for buyers to get a property put together, a purchase put together in this market. And another thing I wanted to hit on was, and this is kind of the second part of this podcast, is that I see a lot of information coming out as to why we are in a housing bubble and why the market will crash this year. And I don't think that's going to happen. And I'm pretty adamant about that. I think there's some market dynamics that dictate that that's just not a reality. But guess what? When you scare people, fear sells. Fear is always something that can be counted on for the media to get somebody to look at, oh my gosh, what's happening with the coronavirus? Am I going to die? Is this something that's going to impact me? Is it going to impact my family? I better check and find out. Well, so often I'll see that in real estate headlines and media, especially in websites. And I see that all the time. And I'll have people say, hey, did you see the real estate market's going to crash? And I'll be like, what site were you looking at? I don't know. I just kind of read the headline. Did you read anything more than just a headline? No, that's all I kind of needed. I'm not in the market to buy or sell right now. So that's about as much as I checked into it. I'm like, okay, but that's not really reality. So that's why I think it's important for me to share my experiences today on why I think the market in Seattle is not going to crash in 2020. Yeah, that was a big that's probably annoying to listen to. Sorry about that. So I pulled up a few articles that I thought were really good examples of what the media kind of hangs out there, dangles in front of us as information and facts that aren't necessarily true. The first one is the U.S. housing market bubble is about to burst as fear sets in. Fear sells. Fear and loathing in the U.S. housing market. There are several, and I'm just going to read a couple of the things that I highlighted that were the key points to some of these articles. There are several signs indicating that a U.S. housing market crash is already here, but the bulls keep finding reasons to celebrate and live in denial. That's all that is well in this space. I read that wrong, but whatever. There are several signs indicating that the U.S. housing market crash is already here. The National Association of Realtors, for instance, has just released a report that say home prices rose in 93% of the metro areas in the U.S. in the third quarter of 2019. But the National Association of Realtors report was laced with caution as the body probably fears that the U.S. housing market is already in a state of decline. So they're kind of taking statistics and wrapping them into whatever format they need for the headline. And oftentimes it's by using the word probably or maybe or sometimes or could be. Those are things that I always look at. Sales of both new homes and existing homes are also down in September, indicating the U.S. housing market crash has already arrived. Yeah, maybe. Or that's just reflective of the fact we've got no inventory and there's no deals being put together. The volume of sales is dropping because there just isn't enough in the marketplace for buyers to be buying, for selling brokers to be selling, and listing brokers to be listing. Your numbers are down. And then the second comment they made is the ironic thing to note is that the National Association of Realtors gave slight hints of a slowdown in its report. Slight hints. Maybe they're just stating the facts, and this article is kind of tweaking it the way they want to. National Association of Chief Economist Lawrence Yun. He's a guy that I follow pretty often because he is the chief economist for the NAR, the Realtors Group. Unfortunately, and he says, unfortunately, income and wages are not rising as fast, and it will make it difficult to buy once rates rise. That's kind of a given. Once interest rates go up, then it makes it less affordable for people to buy. Interest rates are down right now, and it's a super time for people to get in because they can afford more. Their income goes further than it would 6 months ago when rates were a little bit higher. Here's another interesting thing that I saw from Yoon. In some markets, yes, we're seeing construction companies ramp up plans to build more houses, but in an overall comparison of 2019 and 2018, fewer homes have been built. So hopefully home buyers will expand their plans in order to better address the national inventory shortage. The issue with that statement is that home buyers, the length of time it takes from when you buy a piece of dirt to the time you develop it, to the time you get a construction loan, it's really long. It's at least a couple of years in the Seattle market, and it's typically longer than that. It could be 3-4 years if you're doing a big development. So hoping that we can build more homes, that's not going to happen here in Seattle. It's not happening. The basics of it, and I'm not even a college graduate. I dropped out halfway through my junior year. But I did get through micro and macroeconomics. And the main thing about housing is that on the demand curve, on the supply side, supply-demand curve, that housing is inelastic. It's inelastic? Yeah, that's the word. It has inelasticity. I think that's a word too. But it means that you can't build a bunch of widgets super quick. It takes a long time to build a home, and you can't just at the beginning of the year hope, all right, we're going to have a whole bunch of inventory. Those homes have to have been started 2, 3, 4 years ago for them to be in effect today, for them to come on the market in 2020. And yeah, we're going to have some housing come on, new construction housing. I've heard real estate brokers say, well, the new construction inventory is going to come on in the Seattle market. It's like, that's great and all, but that new construction housing inventory, it's not entry-level housing, it's not mid-tier, it's not between mid-tier and top-tier, it's all the most expensive homes on the market, typically. And the stuff that is not, the smaller new construction, is really expensive. It's more expensive than what people want to afford. They can get a resale home for quite a bit less, but there's no resale homes on the market. So saying that the new construction is going to be our savior, that's just not going to happen. It's certainly not going to happen in 2020. It might happen down the road, but it's not here happening right now. And improved affordability cannot drive growth for long. Yeah, that's true, but it's like the interest rates are probably going to go up at some point in time. We're going to look at that, some of the factors. We're at basically historic low interest rates right now and historic low levels of inventory. And a lot of what I'm reading is kind of based on both of those two facts. Here's another thing from the same article. What's more, first-time home buyers need an annual income of $48,000 to qualify for a mortgage, as compared to just about $51,000 in the second quarter of 2019. So people's affordability is definitely better right now. It's just they don't have much to look at. The conclusion from this article is, in the end, it can be concluded that a combination of weak inventories, tepid wage growth, recessionary conditions, and the sliding sentiment is about to send the U.S. housing market into a tailspin despite a feel-good third quarter report. Or maybe the third quarter report was accurate and this article is just, on to a different spin. I don't know. But I don't think we're in for a crash anytime soon. The second article I brought up was from Forbes, and it said, housing market in 2020, boom or bust. 2020 will be a challenging year for the housing market. There are low mortgage rates and a housing shortage, which add to the bullish sentiment, kind of what I'm just talking about. Low interest rates will keep demand high for new mortgages. And there's going to be a continued shortage of new housing inventory in many markets that will contribute to overall price growth. And there's a major problem of affordability. So the level of affordability isn't being met with job growth or wage growth. We've got a lot of jobs coming into Seattle, and that's why I think Seattle is one market that is kind of outside of the norm. We've got a real tech boom going on here that is, we're kind of in a super cycle as far as a real estate market goes. We've got such job growth and so many people coming in and such few properties on the market that it's like there's just this feeding frenzy for whatever comes on. And so right before this podcast, one of the things I did is I looked in our MLS to see kind of what's out there. It's one thing to talk in general about, hey, there's no supply. It's another thing to sit down at your computer, boot it up, get into your MLS. Mine is the Northwest Multiple Listing Association, Multiple Listing Service, NWMLS. And I just kind of took a real quick look at some of the markets. I took a look in Seattle. I took a look at the Magnolia market in Seattle. I took a look at the North Seattle market in Seattle. And then I took a hard look at Seattle, or the East Side markets, kind of over here in East Bellevue and West Bellevue. And the trend I saw is there were a fair number of homes that were overpriced new construction, call it $2 million to $3 million. There was a lot of that. There were some lower and not lower, but call it $700,000-$800,000 new construction homes that are attached, that are probably terrible floor plans, that are sitting. That is the inventory that you are seeing. There's very little resale of normal housing out there. So it's not like I'm kind of making this up and the media isn't making it up either. There's just not much to look at. In some areas, you'll see a map, and normally there's these green pins. You're not seeing that for a lot of areas. You kind of like want to hit the refresh button and go, where are all the homes for sale? Because I'm only seeing like 4 for this 2 square mile radius that is just enormous, that normally should have a ton of housing, and it doesn't. And then when you do look at the homes that are for sale, they've either got a problem, or they're overpriced, or there may be new construction that hasn't been built yet. Those are called a pre-sale. And so there's typically, if something hasn't sold super quick in our market here, and this is for a lot of markets across the United States, there's a reason the property hasn't sold. And so that's a lot of what we're seeing. Let's see if there's anything else in here. I'm going to move on to, this is from the Wharton School of Business. Mortgage rates dropped below 4% this year. We've got a solid economy and strong employment fueled by sales of new homes. In 2020, expectations are that the boom in refinancing will fade out and home sales will increase. But high construction costs will keep housing affordability at bay for many. Home price growth has begun to flatten, and the real estate market is entering 2020 with a fair amount of momentum. And this is from Sam Cater. He is the chief economist at Freddie Mac. That's Fannie Mae and Freddie Mac. They're the two big secondary They contribute liquidity in the secondary mortgage market. So when your loan gets sold, a lot of times Fannie Mae or Freddie Mac will buy that. Prevailing lows in mortgage rates are keys to this growth in home sales. That's one of the quotes, is you got to keep the interest rates low, or the interest rates need to be low for this to kind of keep going. All right, some of the factors that will probably keep interest rates going is that we are in an election year, and I think the Fed will kind of tweak rates to keep them where they're going. Predictions that I've seen is that if something goes sideways, rates might go up to like maybe 4.1%. They're a hair under 4% right now, call it like 3.8. On the low side, they'll go down to maybe 3.5%. So somewhere between 3.5% and 4%. And that's if nothing catastrophic happens. And at the end of this podcast, I'm going to go into 4 different things that are outside of our economy, that are on basically a worldwide basis or a national economy basis, that could really rock our markets, but we're not focusing on that quite yet. One of the major contributing factors to our lack of inventory is just what's happening with the millennials and the baby boomers. Millennials are now in their peak home buying years. Their lagging home buying is now picking up. And that's in this article from the Wharton School of Finance. And a lot of that has to do with millennials are forming their families later in life, and they're making that purchase for housing later in life, and they're having kids later in life. That's been a real trend. And a lot of that has been because I think they are taking longer to kind of figure out what they want to do. They're kind of looking around going, there is no rush to creating this family structure. I've got time. And they're taking their time. And some of that is because housing is so expensive that it's really hard to imagine getting married and then having a kid and trying to jump into the American dream all at the same time. It is super expensive, and so that's a big added pressure. You want to wait a little bit longer until you've got your career going, maybe you've got the dual income family going, because that's about what it takes to get into a home. I've got 2 millennial kids. I've got a 27-year-old. I think my oldest is 27, maybe he's 26 going on 27, and my youngest is 24. So they are on the younger end of the millennials. But that is a real struggle. My older son is an appraiser for Reynolds Kline Appraisal, and he's also a broker for Summit Properties. And he's got the money and he's got the income to get into a house or maybe a condo, but he just doesn't feel the real draw to do that right now. He's kind of happy investing in the stock market and just doing his thing, where he doesn't have the weighed down impact of, hey, I own a house. What do I do with this thing? This is a massive mortgage. I'm going to have to make these payments, for the next 30 years of my life. I think a lot of millennials are avoiding that, and rightfully so. Things have gotten so expensive. It's a massive burden to take on, and I don't really blame them for doing that. So entry-level housing buyers have not really been there. The baby boomers are looking around going, well, I can't really find anything else to retire to, so I'm not going to do that. I'm just going to stay put in this big family home that I've got, and I'm just going to kind of ride this out and see what's happening. And here are some comments from Cater again, the chief economist from the Freddie Mac. Cater noted that the level of unsold existing home inventory is at the lowest ever in the last 4 decades. So these are historic lows of housing inventory we're looking at. And he was citing from the National Association of Realtors. We must continue to beat the drum for more inventory. All right, whatever. Home prices are rising too rapidly because of the housing shortage, and this lack of inventory is preventing home sales growth potential. Yeah, you can talk about housing inventory, needing more housing inventory coming on, but that's not going to do anything. When it happens, it'll happen. When the dynamics between the millennials buying starts to kick in, and when Generation Xers can find their next move-up home, and when the baby boomers start selling their homes for retirement and for basically kind of the last step of their life, then you're going to see those dynamics change. But you can't talk about it and expect it to really change. That's just not how the real estate market works. The bulk of the lack of supply is in new housing, and part of it is in the availability of existing homes whose owners are not trading up. said Cater. There are many Generation X buyers who are still trapped in their first home, and that's because they can't find the home that they want to trade up to. That's super true. We see that every day on the Summit side, is that people want to move, but they can't find something, so they're not going to sell their existing home. And so you get this ratchet effect that, not ratchet as in bad, ratchet as in, and I make this sound as one thing leads to the next thing, leads to the next thing. That's a ratchet. Instead of ratchet, like that chick is ratchet. I hear my kids say that. And yeah, that's not what we're talking about. And so you get this ratchet effect that occurs within the lack of construction, which is not just impacting the entry-level first-time home buyers, but even trade-up buyers. That is what's going on. One encouraging sign is that more and more millennials are embracing home ownership. Millennials are now in their peak home buying years. They're getting older, with the youngest in their mid-20s and the oldest just under 40. Their lagging home buying is now picking up. So, and I think over 50% of all home buyers and home purchases in 2020 are going to be done by millennials. So that is finally kicking in. We've just got these sociological things going on that have kind of wreaked havoc with our market. And we're at this perfect storm of a place where we've got no inventory in the marketplace. Many millennials have begun transitioning from rental market to the home purchase market. They will also dominate the market among first-time home buyers. So that's a real trend that we're seeing. Historically, millennials delayed their entry into home ownership on account of several demographic, cultural, and economic factors. Delayed marriage, having children are factors that began with the tail end of the baby boomer generation and continued in the Great Recession of 2008 hurt millennials as they were forming their household. I think that rocked a lot of people's world. I think the Generation Xers kind of went, whoa, this is not a good thing to have right in the middle of our peak earning years. The millennials looked around and went, geez, you can lose up to half the value of your home just by the market tanking. If I had to move and sell that home, I'd be short selling it. That's horrible. Maybe the millennials had their parents short sale homes. I had to sell a couple of homes. I had a divorce that took place right as the crash was tanking, as the market was tanking. I had to sell some stuff and I couldn't get out. Value dropped. That's a short sale. And I think I had a foreclosure in there too. I know I had a foreclosure. It's kind of keeping track. I try not to remember that, but that is what makes us who we are today, what we've lived through. The broader trends are helpful for the housing market as Cater rounded them up. The economy is in a good place, number one. The chances of a recession have receded, all right. We've got good, steady job growth, all right, good wage growth, and that will support the housing market in 2020. My contention and what I saw come from a good friend of mine, Dan Chapman. He is with Fairway Independent Mortgage of Kirkland. He sent me a clip, and it was Barry Habib talking with the guy in the National Real Estate Post, and it was a really interesting segment. And Barry Habib, he runs the MBS Highway, Mortgage-Backed Securities Highway. It's basically for mortgage brokers. He basically said the reason the market won't tank is because you have to have some pretty significant levels of housing inventory for prices to come down. If those homes aren't on the market, the prices aren't going to drop. There is nothing to drop. And that was the bottom line. And that kind of made a lot of sense to me, is that you have to have housing on the market to drop. And in 2020, we don't have enough time in Seattle specifically for a bunch of property to come on the market. Even in the spring, if a bunch of new construction comes on, that'll get absorbed. We don't have time for that to happen to the point where we've got just a ton of homes for sale. Back in 2006, 7, and 8, when the market did tank, we had a lot of inventory on the market. We had, in 2007, 2008, on a national level, we had about 3.8 million homes on the market. And in 2020, we've got about 1.9 million. We've got half of that. And here in Seattle, you've got less than a 2-month supply consistently. And in big city terms, that's basically sold out. So our market is sold out almost all the time. And what little inventory is on there, it doesn't really count because usually something wrong with it. And a few other factors that Barry Habib of the MBS Highway brought up, where he's done a bunch of research into Google Trends. And this is what's going on right now today. If you look at Google Trends, that is what people are typing into their Google searches and looking at. That is an indicator of what is going to happen now. There are three factors going on right now that Barry Habib points to that kind of tie in with what I'm talking about with the millennials, which are people searching trending topics to do with wedding registry. Now, you don't type in, I know everybody knows that girl who's been since she's 12 planning her wedding, doesn't have the guy lined up, but she does that. So she would be that person typing in wedding registry. But it's become such a trending topic on Google that we know that a lot of the millennials are getting married. My oldest son, Kieran, again, has gone to a couple of weddings. He's in that point where, yep, friends are getting married. They're kind of going down that road. And then right behind that is having a baby. You get married, you have a kid, you go down that road. And so the second trending topic was people doing the baby registry. That is an equally hot topic in Google Trends as wedding registry. And then the third major hot topic in Google searches was homes for sale. So what happens is people, when they get married, they want to put the roots down. They want to buy something. Hey, let's do this. We don't want to really rent anymore. We know the American dream is home ownership. Let's jump on in. So I think you're going to see a big push towards that will, I mean, there's no way with as little inventory as we have right now with millennials buying homes, there's no way that we're going to have a bunch of inventory pile up in 2020. And that is kind of the whole point of this podcast, is that the market dynamics are not there for a crash. Even on the national level, they're not there. There's not going to be a crash. So when you see a crash, and if I'm wrong, bring it up. Let me know. I don't think I will be. And I will go through some things that could happen. I will hedge my bets. I'm a real estate guy. Stuff has come up. The crash of 2001, the tech crash, kind of caught us off guard. We didn't really realize how badly that was going to impact things. California market slowing down in 1991. Yes, I was in real estate then. I was in real estate prior to that. That kind of came, the slowdown of the crash of 91 was really abrupt. Didn't see that one coming. Bunch of factors happened that I wouldn't have guessed, kind of caught us all off guard. So, but there are some national things and worldwide things that I'll talk about in just a sec. Here's an article from Forbes that I thought really tied in well. Was 2020 will see historic low level of housing inventory. That's what I've been yammering on here about. Demand for homes will be strong next year, but home buyers will have few options. In fact, according to a new forecast for 2020, next year may just see the biggest housing inventory shortage in U.S. history. So we've gone from the housing market is crashing to we've got the biggest shortage of housing inventory in the U.S. And guess what? Prices are not going to drop when you've got the biggest housing shortage in U.S. history. They're just not. Real estate fundamentals remain entangled in a lattice of continuing demand, tight supply, and disciplined financial underwriting. Accordingly, 2020 will prove to be the most challenging year for buyers, not because of what they can afford, but rather what they can find. I've heard that quote so many times. It's not going to be about what they can afford or, what area they want to be in or 3 bedrooms versus 4 bedrooms. It's can they find a house that meets their needs, kind of. That's kind of where we're at this year. An increasing number of baby boomers aging in place is part of what's keeping inventory levels so low. Currently, 55.2% of all owner-occupied homes are owned by people age 50 or older. And that is super true. I'm 51. I know a lot of my friends look around and go, yeah, I'd kind of like to move. But in most of my friends' cases, they have kids that are still at home, probably kids in high school. They're kind of just getting through that process. I've been out of that cycle for, 10 years on my oldest and 8 years on my youngest. We've been done with the whole high school thing. And so that puts kind of a twist on things. I can kind of do whatever I want with my housing, but if you've got kids in high school or college, you're going to stay hunkered down and you're probably not going to make a move. We don't see a lot of people making upward moves because real estate's gotten so expensive that why do you want to rock your boat and make that move unless you're just one of those people who has to have the coolest neighborhood. And that's okay. If that's what you want to do, hey, drive the market a little bit further. With unemployment hovering at 50-year lows and interest rates well before historical norms, the real estate industry is being dragged down by scarcity in housing stock, especially at lower price ranges. That's from the Washington Post. So just about every major news outlet is carrying the same story, except for some of these places that do the fear sells thing. And let's see if I can find anything else. Yeah, we've got the one thing that I just read was that the disciplined financial underwriting, that is a key difference between where we're at now and where we were in 2007, 2006, 2007, 2008. Back then, you could get a loan by basically, the joke was holding a mirror up to your nose, because then they'd see if you had a heartbeat and you were breathing. Because if you were breathing, you could get a mortgage. And with subprime lending, that's how a lot of people got into the real estate market that probably shouldn't have been in there, that they couldn't afford it. And when they got into these teaser interest rates loans, when the market went sideways, values dropped, and their interest rate went up, they couldn't get out. There was no exit strategy, not a good deal. And that whole thing just absolutely blew apart. So the National Association of Realtors predicts moderate growth in the housing market and continued low mortgage rates. I'm just reading what a few of the big players in the national real estate industry are kind of predicting. Realtor.com, the real estate listings website, expects inventory to evaporate, making it more challenging for buyers to find a home despite attractive interest rates. Same thing. Redfin, the online real estate brokerage, predicts the housing market will be more competitive in 2020 because of low mortgage rates and a lack of homes for sale. There, Redfin is saying competition will increase with 1 out of 4 offers facing a bidding war. Increased competition will push price growth 6% higher in the first half of the year. That's one thing that I haven't really touched on, is that how much your price is going to go up. Here in Seattle, I think you're going to have a big run. I think you're going to have a march up in pricing, especially at the lower end, because whatever you put the house on for sale, people are going to be pushing that envelope because they know there's nothing on the market. That's what's going to happen. So with Summit and Properties Northwest, my brokerage, and Reynolds Kline, I advise my brokers a lot of times when they're bringing property on the market how much they should put it on for. And for a lot of these markets, because there's been such limited inventory, it's really hard for me to put my appraisal hat on and tell people what it's worth, because I don't have any data. There are no closed sales. A lot of neighborhoods haven't seen any inventory, so there's no data. There's no active listings, there's no pending sales, and there's certainly no closed sales. So that is making things kind of tough for people to figure out. So what you recommend is, hey, price it high. You'll know if you're way overpriced, and maybe you need to make a price correction in the first couple of weeks. A price improvement, I believe, is the 2020 term for when you're bringing your price down. Oh, we've got a new and improved price. It's less now. You can buy it. That's always a funny sell to me. Competition will increase with 1 out of 4 offers facing a bidding war. Increased competition will push price growth 6% higher in the first half of the year. I just read that again, but 1 out of 4 offers. I think just about every offer in Seattle is going to have multiple offer situation. If it's priced well, if it's priced at market, you're going to have a multiple bid situation just about on everything. So real estate brokers out there, get used to the escalation clause again. We had this heavily in 2017. I think in 2020, you're going to crack that form, whatever it is, out, 22E. I don't have all the forms memorized. I should, but I've probably got a video on that in our Summit how-to videos. So let's put a card in the video for Sean's how-to on 22E, if that's the right number. If it's not, we'll just ignore this segment. I am not going to read what Zillow says, because a lot of times their information I don't trust, because their estimates are way off. That's just me coming from the appraisal background. The National Association of Home Builders. The U.S. faces a cumulative housing deficit of about 1 million homes based on population, household formation growth, and the need to replace older homes. this is a really interesting part that kind of fits in here. So I want to read some production numbers. This is again from the National Association of Home Builders. That's kind of the big collective body of builders in the U.S. So production numbers in the 1960s, we're going to call it 48,000 starts. That's what happened in the 1960s per 1 million population. So for every million people in the 1960s, you had 48,000 homes started each year. In the 70s, that was 53,000. In the 80s, 41,000. In the 90s, 42,000. In the 2000s, 42,000. In the 2010s, 21,000. So we cut our production of housing in the 2010s by more than half. And that's what we're feeling now, is that we've got no homes. There's no new construction. Our new construction basically curtailed, and builders are trying to ramp up. But again, it goes back to that inelasticity of the real estate market, especially new construction. You can't build it fast enough for people to buy it. And with labor and land availability here in Seattle, you can't get good contractors a lot of the times, and we've got a growth management issue here in the Seattle market and in the Washington market in general. Growth Management Act has made it so that a lot of the land in the affordable areas has already been developed, or it's picked over, or there's very little left. And so what we've got left are big swaths of national forest and state forest that you can't build on. It's like, okay, we got cool forests, but we're landlocked in between Puget Sound to the west and the Cascade Mountains to the east. And you really can't go north and south too far because you're in Canada or Oregon. So that's kind of where we sit. Now, if there was something in 2020 to rock our real estate market, specifically the Seattle real estate market, kind of comes down to 4 major factors. And they are, these 4 world events could kick off a market crash in 2020. And this is from the standpoint of a financial market crash. But I think that would have a major impact on the real estate market, because the real estate market and the financial markets kind of go hand in hand. You have to have the interest rates to kind of make the real estate go. And if something gets really wicky-whack with our world economy, then things go sideways. And so the 4 things that could, if something were to happen, one of these 4 things were to happen in 2020, I think all bets are off, and we could be off to the races as far as just real estate market going sideways. But this would be on a national level. So when Seattle got hit in the financial crisis, the Great Recession, which to me was a depression because real estate prices fell more than they did in the Great Depression. But the 4 factors are, number 1, the continued spread of the coronavirus. That rocked the stock market here last Friday. Today is a Tuesday, and last Friday the stock markets just got drilled because there's a continued spread of the coronavirus. I'm going off memory here, but I think 361 people at this point have died. There are 15,271 that have been infected, and there are 151 cases outside of the U.S. that are known. And if this, I'm sorry, Nikki, what?
Outside of China.
Outside of, what did I say?
U.S.
Yeah. Nikki is telling me that I had my information completely backwards. There are 150, thank you, Nikki, that was important for the listeners to know, is that this is not a U.S.-based and this is not a joking matter. A virus is not a joking matter, but this is not a U.S.-based virus. This is out of China. So 151 people outside of China have been known. I was reading last night that a little 9-year-old boy who went to go visit his grandma in China over the Lunar New Year is stuck there for basically 2 months because there are no flights coming out of China until 2 months from now. And then even when he comes back, he's going to have a 14-day quarantine period here in the States. So his family's like, he's got to be in, 3rd grade? I'm not sure anymore how old you are when you're 9, but I think it's like 3rd grade, maybe 4th grade, I don't know. hey, how much school is he going to miss because the coronavirus didn't allow him to get out of the country and get back to school? That is really unfortunate for that family. And that's just one story. And so the stock market looks at the coronavirus and they see instability. There's something happening that they can't control, and nobody likes instability. The last time we had this happen was, I believe, in 2003, and we had the SARS virus. It's a virus that happens. We can't control it initially. We don't know what it is. We don't know how strong it is. It freaks everybody out. The stock market doesn't like to be freaked out. They don't like any instability, anything that doesn't go as planned. And so that is one thing. The continued spread of the coronavirus could really have an impact on our financial markets and also our real estate markets accordingly. The second major thing is the potential reignition of the U.S.-China trade war. We just had the signing of the Phase 1 trade agreement between the U.S. and China, which took place on January 15. This seems to bode well for the world's two largest economies, and I'm reading right now, obviously, but investors run a serious risk by taking continued de-escalation in the trade war for granted. This is the reignition of the U.S. trade war between the United States and China. If that goes sideways, or if one of the countries feels like they are being wronged, then they can basically tag the other country and say, we are going to penalize you for the amount that we feel we've been wronged. Take that. So if this happens, you could have a back and forth on the whole trade war thing, and it's not going to be great. So I think the markets and a lot of people in general view this as a temporary ceasefire rather than a peace treaty. And Richard Martin, who is a managing director of Something Asia, estimates that the Phase 1 trade deal has just a 50% chance of lasting through the end of this year, end of 2020. He projects that it has just a 25% chance of lasting through 2021. So that's a pretty major, I think he's an economist, or he's a managing director of Something in Asia. I should know more about this, but I don't really follow the trade wars. That's kind of on the general economic terms more so than what I follow, which is more of the macro on the Seattle real estate level, because that's what impacts me and my brokers and my appraisers on a day-to-day basis. The third thing that could contribute to kind of a big meltdown is the rising instability in the Middle East. This has been ongoing forever, and every time we have a war pop up, this just really rocks things. Now, war is long-term or good for the economy, just kind of gets things going. Like I know in a lot of private circles, people say, we just need a good war to get things going, which is horrible because you've got people dying, you've got innocent civilians dying, wreckage, but it usually happens not on U.S. soil. 9/11 was an exception. You've got things happening not on the U.S. soil, so it's always out there somewhere. And for people on the podcast, I am pointing away from the U.S. because the U.S. is always an aggressor, it seems like, or they're trying to protect our democracy. Okay, but yeah, you're going in and killing a bunch of people. And typically it's in the Middle East. So we've got a long-running war in Afghanistan. We've got a volatile situation in Syria. And just 3 days into 2020, the U.S. military carried out a drone strike on Iranian General Soleimani and 9 other people on a 2-car envoy at the airport in Baghdad, Iraq. The legality of the killing, which followed on the heels of protests and attacks at the U.S. Embassy in Baghdad, has been questioned. Imagine that. And I'm neither pro-war or anti-war or whatever. I just kind of see things as they are, and today I'm just dealing with them on how they impact real estate market. And so from the standpoint of instability in the Middle East, yeah, Iraq could go sideways. Afghanistan could go sideways. I don't think that will because now we're winding down there. It's just a simmering war. And then Syria's always got something going on that's just horrible. And any one of those things could hit us pretty hard. And the fourth thing that could really rock the finance markets would be a contentious U.S. presidential election and political climate. What do you mean, a contentious U.S. presidential election and political climate? I am really not into politics because I think that it's just annoying, and especially this year. The 2020 U.S. presidential election is heating up, and the only safe bet at this point is that it will likely be hard fought and bitterly contentious. It just means both sides are just going to chirp at each other. It used to be, back in my day, I'm sounding like an old geezer, back in my day, people treated each other with respect, and that included presidential candidates. You didn't have people just basically taking verbal daggers out and stabbing each other, but that's become more the norm. That's kind of what you have to have and what you have to do to make things go, unfortunately. Operating under the premise that the Republican, and this is operating under the premise that the Republican-controlled Senate will likely decline to convict presidential Donald Trump. And I think that's kind of a foregone conclusion. The Senate's not going to vote to convict him. And so the impeachment trial has just been kind of a big exercise in saying, hey, we want this to be known for the record, that this kind of activity shouldn't take place. Here's what we're going to do. We know it's not really going to do anything. It's going to waste millions of dollars of the taxpayers' money, but that's what we got to do. So here we are. So if something happened with the presidential election, I think that could have some pretty major impacts. If things don't go the way that people are predicting, which is that we've got another 4 years of the Donald in office, if something happens different than that, then that could really rock the market. If something were to happen to President Trump or to one of the other candidates and something were to really go so wildly sideways, I'm not really sure what that would look like. But yeah, that's one of the 4 factors that could really impact things and make it more about macroeconomic meltdown like the financial housing crisis meltdown we had in 2007 than what I think we're facing right now, which is lack of inventory. We've got great rate, low interest rates. In a lot of parts of the country, we've got pretty decent growth. And so I think, concluding my podcast here, there is no way that we're going to have a crash here in Seattle. A lot of people are saying, hey, you've had a run for too long. Well, that's not enough in economic terms to dictate that we're going to have a crash. Do I think things are going to slow down? Yeah, at some point they will. They have to. They can't keep going like this forever. But we are in the midst of kind of a big super cycle. And until we have our economics slow down and maybe interest rates bump up, we get some more inventory in the market. However that happens, the market kind of sorts itself out. I think you've got some factors going on that are going to lead to a screaming year in 2020. And worst case scenario, we'll have a really good year. The major impact that's going to happen is realtors aren't going to have enough inventory out there to sell. So there's going to be a lot of realtors who are scrambling, trying to find a way to make a living, and that's a tough spot to be in. So everybody kind of just needs to not hope for pie in the sky, more inventory to come on, because that's not going to happen. And I've been saying this since last October and November, that our housing market is reacting accordingly right now. Even though we haven't really entered the spring market, it's reacting now to what's going to happen in 2020. So you heard it here first. These are my predictions for 2020. That's kind of what I think. If you disagree with me, I would love to hear your standpoint. I don't get a lot of feedback just because I think people don't want to take the time to feedback, especially to an old dude with a podcast, a real estate brokerage, and some appraisal firm. But hey, thank you, listeners, so much for sticking with me to the end here. I hope you enjoyed this podcast. We will have this podcast on our Summit website. We'll also have it on our Facebook, and we'll probably have at least a few mini episodes from this podcast that you can watch on YouTube. We have a super active YouTube channel. I think right now we're approaching 600 videos. We've got a ton of videos out there. So if you are in real estate and you are looking for content, we have got it. So thanks again, listeners and viewers on YouTube, for listening and watching to this point in the podcast. I really appreciate your participation. I look to hearing what you have to say, and let me know what you think of this solo podcast effort. We haven't really touched on that at all, but I want to start doing some more of these because I want to get in the habit of doing more reps, and the more time I do podcasts, the better I get. The better we get at the equipment, the better I get at kind of developing the concept for each podcast and physically doing it. Love to have more guests on, and we will do that, but this is part of it. It's a matter of Joe Rogan's got, I think, close to 1,400 podcasts, and I've got, I think, 13. So I am a small, tiny fraction, 1/1000th of where Rogan's at. But the only way you get better is to keep doing them. So thanks so much again for listening. I will catch you on the next podcast. I appreciate it very much. I'm Sean Reynolds from Summit Properties Northwest and Reynolds Kline Appraisal. We'll see you on the next one. Bye for now. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.